From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, this is the Hamilton Place Strategies Macrocast with our friends from Markets Policy Partners. Every Friday, we take a look at the big economic policy and data stories of the week, and we look ahead at what to expect next week. My name is Tony Fratto, founding partner at HPS. You can check out Hamilton Place Strategies at www.hamiltonps.com. We also tweet at HPS Insight, and I tweet personally at Tony Fratto. I got to know John Fagan during his time running the markets room at the U.S. Treasury Department, and Brendan Walsh when he was a senior analyst at Discovery Capital, covering global financial institutions. John and Brendan founded Markets Policy Partners, where they provide independent financial market analysis for, among others, public sector audiences. You can find them at www.marketspolicy.com. It's Thursday, June 20th. John and Brendan are in Washington, D.C., and I'm coming to you today from Brussels, where we just had the Institute for International Finance conference today here, and give you a little, and since we're going to talk a little bit more about Europe today, finally, John, Brendan, I think we're going to get into Italy eventually on this show. We've been trying to do it for weeks, but we had news this week. We had Fed policy news, we had ECB news. In fact, the ECB preempting the Fed. That sound you hear are doves flying everywhere, isn't it? Yeah. So Mario Draghi, came out and ahead of the highly anticipated, FOMC meetings this week, and indicated that he's still, whatever it takes, markets liked it, didn't they?
Yeah, they certainly did, and as you point out, traders are referring to this as whatever it takes, part 2, the sequel. Right. And so Mario Draghi from the European Central Bankers Conclave in Sintra, Portugal, that they do every year, really set the dovish tone for the week on Tuesday morning when he referred to the potential for additional accommodation, specifically tapping rate cuts, and even flagging more potential headroom in the asset purchase program. And yes, as you pointed out, this was very well received by financial markets, and it was a bit of a surprise, as you said, and it comes right on the heels of the ECB just fleshing out the details of their concessionary loan program at the previous meeting, the so-called TROs. Those that was, the ink was still fresh on that, and with Mario Draghi, the man a lot of traders call Super Mario, and putting his well-known abilities to move markets and surprise markets right in the spotlight on Tuesday. We saw the euro drop. We saw European and actually global equities rally pretty sharply. And certainly EU sovereign bond yields sink to pretty notable lows, dragging U.S. Treasury yields along with them. And this was even before the Fed's performance on Wednesday.
Brendan, the euro drop was noticed by somebody a few blocks from our office there in D.C., wasn't it?
It seems that Mario might have started a little currency war. And, I think Mario's actions were kind of Machiavellian. He only has a couple meetings left. And right after his press conference, there was large pushback from a lot of the northern European central bankers that were meeting. They were saying, hey, pump the brakes there a second. That's not exactly what we talked about. But Mario has 2 meetings left. So I think he kind of wanted to make the bed for his predecessor that they couldn't, get out of it, because the odds are that whoever follows him is going to be probably German and a little less super.
Well, the succession issue really is it is something that is clearly in the background, and we saw with Bernanke's, before Bernanke's term was up, before Yellen's term was up, a lot of Fed watchers thought that some of their actions were dictated by, just as Brendan said, the a desire to set the table or make some of the hard decisions, use their long established credibility and bona fides with the markets to make some of the tough decisions, so it's not left to their untried successors to make
right, like
chunky.
Yellen started the quantitative.
Right.
I'm sort of torn on this a little bit. I feel like look, I think Draghi's trying to do the right. I think he's trying to do the right thing. I think that the next guy is going to have pressure to to not be as from their view, right, from the German view, Draghi is profligate, and so there'll be pressure on that next guy. But I think back to when when Bernanke followed Greenspan, and he came in, and Greenspan had in place the 25. We were in the midst of the 25-point step up, post. Post recession, post tax on Wall Street, equity bubble popping, and the millennial, right? It was like all these factors coming together as to why we went so low, and so we were on this pace of the quarter point step ups, and I think that was a mistake, right? It was sort of, you know where you want to get back to some range of based on your view of the world and output and unemployment and price pressures, and so but being it's not obvious that happens in a steady linear fashion
exactly.
of 25 points for over a period of 2 years. That's just it doesn't make any sense. But Bernanke was kind of stuck with it, and because he was following the maestro, it would have been difficult for him to make a dramatic change.
Yeah, and when he paused in the summer of 2006, that really took the markets by surprise. Everyone just thought we were on cruise control, and that at that point the housing market was being discussed, but it was not consensus that it was the bubble that it became.
Yeah, that's right. You could have used the helicopter Ben a lot earlier, right?
Without a doubt, because the next cut was like 100 basis points.
It is amazing, right? I mean, that was in 2006, and but you get into the summer of 2008. This is when central banks they have a tough job. It's like and it's always easy to look back at the mistakes they made, but Trichet, then president of the ECB, in 2008, actually raised rates in July of 2008.
Yeah,
right?
And he was applauded for that.
He was, yeah.
In Draghi's turn, I think it's drawn, obviously positive reviews, positive price action in financial markets, and he's obviously well respected, and his track record is obviously incredibly impressive during his tenure. If you can have Portuguese yields below American, you probably deserve a pat on the back.
But the yields are stunningly low. I mean, I'll tell you, I saw Jean Lemierre was here on a panel. He was the former head of the European Bank for Reconstruction and Development, now chairman of BNP Paribas. And he was, he understood, he understands where Draghi is, understands where we are, where the economy is, and why, easy monetary policy is where we need to be. But he was, sort of bemoaning, like, here we are. It's been a really long time to be so low, and you would have thought that we could be in a place where rates are where, at least if you're at a certain age and you have a certain level of experience, you think, is something like normal for a range of rates, and we're nowhere near that. I think that's hard for for a lot of people, and he was sort of bemoaning that we're in a very accommodative environment, and we're going to be in an accommodative environment for a very long time. And of course, it's really difficult for European banks to actually make any money. Right? They can't make money. Their return on capital is negative.
When Mario Draghi, in his comments, when he flagged the potential for additional rate cuts, he did refer to potential mitigating measures that they could put in place. I guess that would be referring to a potentially tiered deposit system we've heard ECB officials chatter back and forth a little bit about that. It's not clear that they really have any plans in place, but Mario Draghi certainly mentioned it in connection when he just right after he talked about the potential to cut rates. But I mean, looking at the way that rates are and the policy settings are certainly one thing. They're eye-poppingly accommodative, but looking at the data, it's hard to look at the data coming out of Europe and the market-based readings of inflation expectations and say this was an inappropriate policy shift toward a more dovish setting. It's the economic readings. Manufacturing PMI is in contraction in the core of Europe and Germany. The five-year inflation swap, which is Mario Draghi's his very favorite market-based gauge of inflation expectations, below where it was in 2016, where we had a deflationary scare. I mean, it was down at 1.1%. That's eye-wateringly concerning levels there, and so it's certainly he was able to. The fact that Mario Draghi was able to surprise the markets in a positive way when fundamentals were, perhaps, screaming for some kind of action from the ECB, I think speaks to his mastery of the craft here.
Yeah, but going back to your point about the president.
Actually, I'm going to be in Germany. I'm going to be in Germany next week, and and I'm pretty sure, like, when I cross the border, I think they're just going to hand me buns, right?
Hey, they do.
Right? They're just going to give them away now.
And that goes back to your point about the president, where I hope we're not starting a currency war, but he does have a point where, Japan and Europe are low forever, and the dollar has been at the high end of its strength for a while now. But the fiscal side in Europe has still kind of been austerity. So while I don't want to, give him credit for bickering, he does have a point that it's not fair.
Brendan, let's fast forward from Tuesday to Wednesday then, and with FOMC, and it's a highly anticipated meeting for Jay Powell because of the president's mostly overwhelmingly because of the president's
exactly.
Seeming, pulling out the bullhorn and putting pressure on him, and questions about whether the president could remove him from the job. And so a lot of attention this week. And then you have the currency questions and Draghi's comments the day before. So it was, very highly watched. Mm-hmm. And, he seemed to get through it okay, but and signal very clearly to markets that, get ready, cuts coming in July, right?
Yeah, so right now Fed Fund futures are at 100% for a 25 basis point cut next month.
Yeah, actually, and the odds of 50 basis point, a lot of Fed watchers and analysts on Wall Street are tipping a 50 basis point kickoff to this what they see as an easing cycle. And the odds of 50 basis point, I think, are around 25% for the July meeting. That would certainly.
John, you just made the data dependent case for Draghi's signaling. Can you make the same data dependent case for Jay Powell?
Sure. The Fed would. The Fed would tell you that inflation, he talked about uncertainties, particularly overseas uncertainties, and that's, that dovetails exactly with what Mario Draghi is responding to, and weakness in, certainly in, Chinese economic data, Japan, South Korea, the Bank of Korea came out dovish last night. It's the global growth slowdown is something that the Fed is right to contend with. They're a little bit cagier about their assessment of the U.S. economy. They still speak pretty favorably about it, although we've had economic data being a mixed bag. But
the New York manufacturing index and the Philly today were kind of shockingly weak.
Yeah, there's clearly something going on, and as we said last week, the non-farm payroll number was a little bit of a disappointment. But the where they're really hanging their hat is on that inflationary downside risk, and whether it's PCE, whether it's market-based gauges, the break-evens that we've talked about, and inflation swaps. That's really where the data-based justification for the Fed to be moving is. But, the Fed is still, what we've seen is, again, the Fed pivots the market sets a dovish benchmark. The Fed pivots toward it. And then the market assumes an even greater dovish. The goalposts keep moving.
Right.
So
for the last 9 months, the market has been the best predictor of what the Fed can do. They basically acted with a 2-month delay.
I generally think that's where. I mean, look, I've said this for a really, really long time, and I don't think I'm the only one who's ever said it, because I don't think it's original observation at all. But that, like, sort of look where the 10-year is, and that's kind of where the direction the Fed is generally going to go. I mean, it does tend to follow a little bit, follow more than it does lead.
If you mean 100% correlation, then yeah, you're right.
There's certainly, the commentary in the markets.
At least lately.
The commentary in the markets, of course, you have self-serving and sort of self-centric narratives in, I think, probably a lot of different quarters when it comes to the Fed meeting. The market basically is, we see a lot of commentary from analysts saying the market basically is pushing the Fed. It's leading the Fed by the nose. It's been doing this for quite a while now. It sets market policy. The bond market sets the policy, and the Fed ratifies that. Of course, if you went to the West Wing and said, why is the Fed turning dovish, there probably would be some thought that maybe the pressure from the West, political pressure, is finally getting through to these guys. And if you go and talk to the people at the Fed, they would probably say, no, they were looking very closely. The data is leading us to this conclusion. So everybody's got their own narrative as to maybe why the Fed is doing what they're doing. But the fact remains that the market really has moved. So now the base case is no longer 2 rate hikes by the end of the year. It's now moved to 3. There's a considerable cuts. Sorry, sorry. That was a residual from last October. And certainly decent market implied odds of a 4th cut. That would be a full percentage point of rate easing by year end.
So this also, the Fed statement was interesting because they clearly said that if the trade negotiations with China are negative, then we'll cut. But that also, on the flip side, opens up that if you cut a deal, then they don't have to cut. So the Fed statement probably plays into Trump's negotiation with China. You don't want to cut the deal before you get your Fed rate cut.
Between now and the next meeting, if all of a sudden the U.S. data kind of turns around and we get some really upbeat, constructive dialogues going with China, and we start moving toward a deal, the Fed is going to find themselves.
Brendan raised that last week as a conspircy theory, and called it a conspiracy. Yeah. And like now, I'm thinking every time I read this week, since the press conference, I'm thinking, man, he might be right.
I know.
He was going to.
It might not have been the initial plan, but it might just work out that way.
Well, okay. So why don't we take a break? And we have a lot of stuff still I want to get into. Well, actually, one of the things I'd like for us to get into after the break too. I'm going to ask you if there's another. We're going to be looking at another central bank in the world. That's the Facebook central bank with a new currency called the Libra. Let's take a break right now. You're listening to the Macrocast. This is Tony Fratto coming to you from Brussels, John Fagan and Brendan Walsh in D.C. All right, and we're back on the Hamilton Place Strategies Macrocast. John Fagan and Brendan Walsh from Markets Policy Partners in Washington, D.C. I'm Tony Fratto in Brussels. Guys, so Italy... Italy is still in a tough situation. They're going to be in a tough situation for a while. The political situation is still difficult for them. They're still battling with Europe. What do we make of where they are right now?
Well, I think in a very short take, it's the picture isn't necessarily a pretty one, but the market reaction and the way that markets are reflecting, we've seen a lot worse than this, and that's reflected in where Italian bond yields are. And this was even before Mario Draghi pulled the anything whatever it takes part 2 out of his hat on Tuesday morning. The counter trend rally we'd seen, decent pressure building in Italian bonds. The spread is what they look at, and that's the Italian yield, the sovereign Italian yield differential over the German Bund equivalent duration, and they call it low spread according to the the Financial Times. I don't have the proper pronunciation, I'm sure, for the Italian version.
Pretty good. Low spread.
Yes, I'll defer to you on that one. The current level is about 240 basis points, and the threshold of pain has been somewhere around 300 to 400 in the past, and that's 240 and falling. The initial turnaround was after Deputy Prime Minister Salvini, the head of Liga, indicated that he was not looking to precipitate a general election. After the European parliamentary elections, when Liga really outperformed, and Five Star, its coalition partners, sort of began to look very much like the junior partner. Speculation was that that Salvini and his northern Italian populists were really getting the wind in their sails, and were going to start standing up in a much more aggressive way to Brussels and seeking a general election to kind of ratify that at the voter level. But he. By saying that, who knows whether this is going to last, but by saying that he's not going to go for that, the bond market in Italy responded very positively to that, and the sort of show of unity among Salvini, Di Maio, and the Prime Minister Conte over at least trying to take some steps to see off penalties that the European Commission might levy on them for fiscal profligacy, and that's something that the European Commission, the process has begun officially, but instead of taking a hard line, at least for now, it looks as though they're going to try to that Rome is going to try to meet the EC, the European Commission, halfway.
It looks that way. Yeah, I mean the idea that there would be another election really just spooked everyone. And actually, I was surprised that Conte, of all people, was pretty strong on essentially saying, look, if put the toys down, I'm out of here if we don't just focus on the job at hand, and that's what the Italian people want. And I think that was a good signal, right, from a government you're not going to have a whole lot of confidence in, but maybe they're modestly understanding the reality of their situation.
Certainly, and now with Mario Draghi tipping that there's headroom in the asset purchase program, obviously there's a sense that where is that headroom? Purchasing more bunds, probably more in the periphery, and the idea that. Among all the different things that Mario Draghi said, certainly, additional accommodation in general is going to be helpful for Italian sovereign debt valuations. But it's not necessarily the rate cuts I would think that the market's focused on in that case. I think it's the prospect of additional asset purchases by the ECB, which would include Italian bonds, presumably, that has spurred this rally. So we're not out of the woods, but the markets are. We're even seeing it in Italian bank stocks, which have been trading at really they've been at very, very depressed levels, and they've been slower to react than the bond market. But even in the last few days, we've seen some more upbeat trading there, and they're coming off the lows.
Well, hey, I wanted to get into something else fun, which is that we've got another currency to track now. It's going to be called the Libra, that the Facebook will be issuing, along with a really impressive, actually, consortium of partners. But so we have to pay attention to another currency here. Like, what do you guys think of it? I'll tell you, it's come up in like half the panels. Today, and even in a number of the meetings I was in yesterday.
Well, they're definitely paying attention to it on Capitol Hill. Yes. Maxine Waters didn't waste a lot of time. It was that very same day she called on Facebook and the Libra consortium to hold fire on development, and it wasn't just this wasn't just on one side of the aisle. It was there was a variety of different voices from Capitol Hill saying this, and we've seen, from the there are obviously people that are much closer to this than I am, but the regulatory there's been sort of a constructive ambiguity on the regulatory approach at the various agencies in D.C., the federal agencies, toward cryptocurrencies, and maybe this is a precipitating factor. Some analysts have pointed out that this is going to force Capitol Hill and force regulators to really start confronting this issue in a more with greater clarity and substance. So that's a positive. That's a silver lining, I guess.
Yeah, and from what I've looked at it,
go ahead, Brendan.
This seems a little less like Facebook trying to create another dollar and more like them trying to create a payments currency that allows them to avoid bank regulation.
Yeah, that's what I got from it too. And I actually thought that I thought the Hill reaction to it was outsized for what is actually for what they're actually trying to do. It's really about payments, broader system on payments. It's not that there aren't consequences. I mean, one of the things I liked about just about the way they structured it is that they're actually given thought to backing of it, and it's going to have a basket of currencies, and it's not on some it doesn't require burning all kinds of power for people to mine, computer programs and things like that. It's actually things that we're familiar with, which is called currency, that are backed by the full faith and credit of governments, and you put it in a basket, and that's what's going to back up, their coin for transactions. And so I thought it was actually, of all, of a lot of the crypto ideas out there, was one of the ones that actually was thinking about the fact that money is different from other things.
Right, because this really isn't a cryptocurrency in the same way that Bitcoin is, Bitcoin is designed to try to avoid governments. This is much more of a digital currency. I don't know if the Facebook thing is going to be successful or not. I think it is positive because it brings this discussion to the mainstream, and we can kind of, instead of just throwing words out that some people think are positive and negative, actually have an intelligent discussion about this, because this isn't going anywhere, and someday we probably have digital sovereign currencies. So the path that we get there can be bumpy, or it can be something that the governments and the technology work side by side.
There's also a chance that that Capitol Hill and U.S. regulators sort of take a pass on the deeper questions about payments and cryptocurrencies and that sort of thing, and focus on governance of Facebook, and obviously Maxine Waters focused that she was it wasn't so much. There was obviously there were questions about the cryptocurrency, but the questions really the focus was really on Facebook itself. The questions that are percolating on Capitol Hill about the governance, the privacy, and certainly the antitrust investigations are going on right now. And so it's possible that they just turn this into another part of the Facebook-oriented sort of inquiry, rather than trying to grapple with the issues of Libra. That would be a little disappointing, but not necessarily out of out of character. In terms of the DC approach toward cryptocurrencies, it's really hard to nail down the regulators and get clarity. I think ambiguity is very useful for regulators because it keeps everybody it keeps everybody on their toes.
Yeah, if you're the CEO of a big bank, you're loving all this stuff because it's kind of clear that the Eye of Mordor has moved away from New York City and is planted squarely on Silicon Valley.
We squeezed it into the Macrocast. I think it'll be a long time before we think of it in any way as a macro issue. But definitely it's fun to talk about a new currency here. When we come back, let's talk about oil and then look ahead to next week. I mean, oil has been pretty volatile because of events in the Straits of Hormuz the last couple of weeks. So let's lead with that when we get back, and then take a look at what we can expect next week. You're listening to the Macrocast. This is Tony Fratto coming to you from Brussels today. John Fagan and Brendan Walsh in Washington, D.C. We'll be back. All right, we're back. You're listening to the Macrocast. This is Tony Fratto from Hamilton Place Strategies coming to you from Brussels. John Fagan and Brendan Walsh, Markets Policy Partners in Washington, D.C. And, so oil's been something to watch the last couple of weeks, hasn't it?
Yeah, it certainly has. It's been on just to set the scene, oil prices have been on a pretty sustained downtrend, sharp downtrend since late April. Brent crude, the international benchmark was up around $75 a barrel and came sort of screaming lower in the midst of a buildup of fundamental headwinds for the most part. Rising supply and U.S. supply from the shale patch, obviously pretty notable, but the degree of downgrades on the demand side because of the slowing global economy really knocked oil for a loop, and we saw, increasing tensions in the Persian Gulf. There was a tanker. There were commercial vessels attacked in May, and last week we saw tankers attacked again, and the upside in crude was remarkably fleeting. It was really. The degree to which the negative fundamentals sort of overbalanced that geopolitical risk premium, that geopolitical risk response was remarkable. We're seeing oil prices after the drone shoot down this morning, where the Iranians took down a U.S. drone, and there's obviously debate over exactly where it was, but the oil prices are up, so Brent's up about 5% today. That's a pretty meaningful. That's a pretty meaningful leap. But keeping in mind, we're pretty low. This is only taking Brent crude up to $64 a barrel. And if you're looking at, we've often talked about markets as a constraint on policymakers and on certain on a variety of different things that we can do on a national security level as well, and certainly mixing it up in the Middle East. Higher, rising and sort of punishingly high oil prices are a potential constraint. But basically, Brent crude at $64 a barrel isn't dissuading anybody from anything.
Well, we're going to keep an eye on that again, looking ahead to next week. Any data we have to pay attention to?
It's a relatively light week. We get durable goods and wholesale inventories, a few data points on the housing market. But the thing that probably the market's going to be paying most attention to is the PCE price index for May. So the core PCE price index is what the Fed pays most attention to, with a 2% inflation target. And if you kind of extrapolate from the CPI and PPI data we already have, it looks like the year-over-year number is going to be a mere 1.5%. So maybe that 100% pricing in for the July, can it go up to 150%, or is that 100% the top?
Right.
We've already achieved metaphysical certitude.
Yeah, exactly. And then next week, of course, we'll be looking at a potential Trump-Xi meeting on the sidelines of the G20. They've already indicated that, trade talks are going to, start back again. I think people are, going to be cautious about anticipating after they signaled the last time around that success was at hand. I think people are going to be more cautious about it right now, but certainly it sounds like pointing towards lowering the heat in that relationship. But we'll see. That's just something we'll be paying attention to next week when we'll be back with you again next Friday. This is Tony Fratto, Hamilton Place Strategies from Brussels, here on the Macrocast, along with John Fagan and Brendan Walsh in Washington, D.C. Have a terrific weekend, and we'll talk next week.
Thanks for listening to the HPS Macrocast, produced by Hamilton Place Strategies in association with Markets Policy Partners. For more from Hamilton Place Strategies, follow us on Twitter at HPS Insight. For more from Markets Policy Partners, please visit marketspolicy.com.